Hi, I'm James Robinson. I manage money for a living. My company is called Robinson Stocks, and this is my stock pick of the week. This is part 3 in my series on the company Encore. The other videos on Encore will be put down in the comments as I publish them. This video is on the balance sheet for the company. There's a number of reasons why we look at the balance sheet. Classical Graham from Security Analysis, you might be looking for companies where the company's net assets are bigger than the stock price, higher than the stock price, higher than the market cap of the company. And as a result, you're looking at buying a company with virtually no risk. Those companies don't exist very much anymore. The bigger and better reason to be looking at the balance sheet now is to get a sense of the debt for the company is a problem, if interest payments are a problem. Another thing is if the company's a very well-run company and the company has a consumer monopoly, it ought to be throwing off enough cash to fund its operations. So if you see a company that seems to need to borrow money to finance their operations, that's a pretty good sign that they don't have a consumer monopoly, and that might be a reason to pass on the company. This company, Encore, the balance sheet is very, very strong, as we'll see in a minute, and that's one of the reasons why I think you should buy the company. Any research into a company's balance sheet should start with the company's cash and marketable securities. Cash is obviously cash. Marketable securities is securities that can be very readily sold for the benefit of the shareholders or the benefit of the company. So effectively, it's cash. The interesting thing when you look at this company is that in 2012, this company had, call it $25 or $30 million in cash. Today, they have about $450 million in cash. And even that is as of the end of the 2021 fiscal year. Since then, the company's put even more money away, and I think they're about $550 million today in cash. So that means they've increased their cash about 20 times in 10 years. Now, obviously, the most of that has come in the last 2 or 3 years. As we talked about in operations, this company's done very, very well the last few years. But even leading up to that, during the years before that, it had gone from 25 million to 220 million, which is about 10 times. So that tells you that there's something going on here, that this company is not only running the business effectively, but that they are able to hoard some cash. One of the reasons they're hoarding cash is they're not paying a dividend, which I would like them to do, but they are buying back a bunch of shares. But long story short, this company has plenty of cash on hand to meet any of its needs. They are generating enough cash to run their operations, and so that's a very good sign. Like everybody on YouTube, I'd love it if you would subscribe. Also, I don't have time often to make videos, or rather I make videos some period of time after I typically buy stocks. So you'll oftentimes find information as well as articles that I find interesting on my Twitter account. That Twitter account is @RobinsonStocks. You can see here's a map of where my subscribers are. I'd love to know where you're watching from. I like to keep track of where they're from. Obviously, it's the only way I'm getting any gratification out of this thing. Just knowing that there's people around the world following, and you can imagine it's pretty cool when somebody in a city somewhere I've never heard of starts following me. My goal is to get to 1,000 subscribers. I'm at about 432 as it stands today. Obviously, I'd like to get that number higher and higher. So please feel free to subscribe. Current assets and current liabilities. Why do we look at this and what does it mean? So current assets is assets that you currently have in the bank or that you will have in the bank in the next 12 months. And generally it's receivables, things like that. Current liabilities is money that you owe or will owe going forward. So what's fascinating about this company is that they've managed to grow their current assets pretty significantly. Most of that's happened in the last few years. You can see they've got over $1 billion in current assets. That's spectacular, especially when you look at the fact that they had about $200 million in current assets a couple of years ago. So obviously that's a result of the fact that their sales have exploded in the last year or two. But the interesting thing is that current liabilities as a business is growing, the current liabilities will often go up. That's because you have to hire new people, you have to lease new equipment, lease new office space, et cetera, et cetera. And this company while its earnings have gone dramatically, the change in current liabilities is very, very small. That tells me that this company's margins are increasing, that this company's sales are spectacular, and obviously it's a very, very good sign. So we like to see current assets always above current liabilities because that means the company can pay their bills in a timely manner. When we see current assets below current liabilities, that's a real bad sign that the company may be in some real financial distress. You can see that in 2019 to 2020, they were very close to the same number. That would have been a red flag for me. But again, over the last few years, things have just gone great. Current ratio is the ratio of your current assets to your current liabilities. So it's the ability over the next year to pay your bills. And the fascinating thing about this company is that we looked at the last slide and it looked like these numbers were pretty close, but they're actually not when you look at it through this ratio. And the current ratio of this company has been in the top 10% of companies really for the duration, for the time it's been in business. That tells you that this company is very conservatively managed. Obviously, the fact that they have no debt is obviously a good sign of that. So long story short, the current ratio has always been very, very good. It's been very, very stable, and so we really like that. Here we can see the debt analysis for the company, and the first thing to note is that the red line is long-term debt. Long-term debt is debt that you owe, but you don't have to pay it back in the next 12 months, so it's a period of longer than 12 months. Typically, your bonds are going to be that way. Typically, a bank note is also going to be that way. An example of a current liability would be rent that you owe in the next month or 2 months or 3 months, for example. Obviously, we love companies that have no debt. It's one of the things that really, really gets me excited, in large part because it means that the company has no interest expense. So that makes it easier for us to pay our bills. It typically gives us a competitive advantage against other people in our industry who are more likely to have debt. Another thing about company having no debt is that you don't have to take any of our future profits and use them to pay off debt. And that means that those future profits can be used for other things, hopefully dividends and buying back stock, but other things that might create value for the shareholders. So having no debt is a spectacular thing for a shareholder. The other side you see is current liabilities. You can see the current liabilities have gone from about 40 million in 2011 to about 160 million today. That's a 400% increase. But as we've talked about, that's got to be put in context because the profits have gone up so dramatically over that period of time. As the company makes more money, they have more and more money that they need to spend in the production to make that money. So if you're going to double the amount of wire you're producing, you probably need more machines to do that. You probably need more staffing to meet that needs, and you might need more space, and all of those things would cause your current liabilities to go up. So I'm not really worried about companies that have current liabilities going up. What I like to see is that the current liabilities are going up more slowly than the profits. Normally, I would spend more time looking at the company's interest payments and the interest expense, but the interest expense here is zero, so there's not much to talk about. Other than that, that's fantastic. It means that it's going to be easier for us to make a profit. The other thing here that's kind of interesting is you look at interest income. The company has made significant interest income relative to its expenses. It's not very much money in the scheme of things. It's about 1% of the profits in 2020. And by the way, I'd like to see that money being given back to the shareholders versus being held for its interest expense profitability. But there is some interest profitability, and so I've demonstrated that here. Interest coverage ratio would only really matter if the company had interest expense, and since they don't have any interest expense, we don't have to worry about it. You can see that even prior to paying off the debt, the company's interest expense ratio was massive. About 300 times. A goal is 1.5 times. So I want to have an interest coverage ratio of at least 1.5 times. And this company had, 200 times that, which is just an example that this company is very conservatively run. Even when they had some debt, which they apparently needed to run their business, the debt interest payments were never going to be an issue with the way the company was run. One of the real problems that I have when I do these balance sheet and also when I do the dividends is that sometimes there's not much to talk about. If the company has no debt, then there's not much time to be spent on a chart that looks at years' income required to pay off debt. And so it seems like I'm being redundant, but what I really want to do is drive home the point to you that there's an awful number of companies in the S&P 500 that you might look at and say, I'd like to buy this company, but it has tremendous amounts of debt. And all of that debt is a negative. All of that debt is something that should discourage you from buying a company. And so when you find a company that has no debt, I think you should dwell on it. I think you should really consider that the fact that it has no debt is a very, very good sign, and it should give you extra incentive to buy the company, because you don't become a company today in America that has no debt without doing an awful lot right. And so while it seems like I'm being redundant when I say this stuff, it really is worth spending some time thinking about. Having said that, again, here's another look at the fact that interest expense is irrelevant relative to operating income because there is no interest expense, and sort of that's all I need to say about this. Debt to equity ratio, again, it's perfect. There is no debt relative to the amount of equity, and so the company's great. So that's going to do it for the company's balance sheet. They have about $500 million in cash. They also happen to have about $500 million in real estate. That's not easily liquidated, but it is a long-term asset. That's made up of 2.8 million square feet of warehouse space and about 450 acres of land around it. In my day job, I used to be a guy who leased office space, pretty aware of the market for industrial space. It's red hot. I have no doubt that they could lease their industrial space out very, very quickly. I have no doubt that they could develop that 450 acres into more space if they wanted to do it, if they wanted to become a real estate player. So there's lots and lots of assets on the books. There's no debt on the books. They don't have to worry about interest expense. So the balance sheet for this company is, a 10 out of 10.